Good afternoon, everyone. Thank you so much for joining us for today's webinar. My name is Stephen Sadler. I'm the Head of Customer Service here at Retirement Essentials. I'll be the MC for today's webinar. Our advisor, Nicole Bell, will be doing most of the talking, going through each of the topics. Just a bit of background in terms of Retirement Essentials, who we are and why we're here today. So Retirement Essentials is a private organisation that believes everyday Australian seniors deserve an easy way to feel in control of their finances and have peace of mind during retirement. We try to do this, offer this control and peace of mind by providing affordable, bite-sized retirement advice services that can help you at whichever stage of the retirement journey you might be up to. The key purpose of today's webinar is to talk through the 2026 federal budget, the proposed changes that have come out. So Nicole will go through each of those and highlight what may or may not be relevant to yourself. There is a little bit of housekeeping that we do need to go through though, just before we do dive on in. So I'll just go to the next slide. So the information we're discussing today is not intended as personal financial product advice, legal advice, or taxation advice. It does not take into account your personal situation, goals, or needs, and you should assess the appropriateness of this information given your own financial situation. Please ensure you do read the relevant product disclosure statement if you choose to make any changes to your financial situation. So if you do wish to ask any questions along the way, please do. We love it. We're going to have a Q&A session at the end. The idea of today's session is we spend roughly half an hour on the presentation itself and then 10 to 15 minutes on the Q&A at the end. So you should see the live chat on the right-hand side of the video if you're watching on a computer. If you're on your mobile, it may be down below. So please just post your questions in there as they might come up. Please do remember, though, that this is public, so anybody else who is viewing this session can see those questions. So please don't put anything personal in there, or anything that is sensitive in nature. Also, please bear in mind that this session, we will send a link out at the end of the session to everybody who's attending to come back and rewatch it as many times as you may like. So the goal of today is to just please watch and absorb as much as possible. Don't worry about frantically trying to write down numbers or scribble things down. You can always come back and rewatch the session if you need to. Just watch, absorb, post questions if you have them, and then we'll hopefully try and get through as much as we can in the Q&A at the end. The agenda for today, the key topics we'll be covering off, is up on the screen in front of you now. So there's 6 things in total we're looking to get through, including the Q&A session at the end. And without further ado, I'll hand over to Nicole Bell, our financial advisor, who's going to be taking us through these topics today. Thank you, Nicole.
Hello, everyone. As Stephen mentioned, we're working through the 2026 federal budget highlights because we really know how to party at Retirement Essentials, and everyone is really excited about changes to tax and other implications that come with a budget. So some we will expand on more than others, but are we really focusing on highlighting the things that can potentially impact retirees, obviously, because they're the people that we care about the most. So just to start with, this is a little bit of a higher level agenda, some of which we're going to expand on a little bit more. So if you think I've skimmed over it quickly, no, do never fear. We are coming back to a lot of these topics a little bit later. At a higher level, the $1,000 instant tax deduction, which is wonderful. We love a good tax deduction. But what this really does is for anyone who has typically less than $1,000 worth of work deductions are now able to claim up to $1,000 without receipts. Ultimately, if you tend to have more than $1,000 of deductions, you still need to keep receipts, you still need to track it, you still need to justify it. You don't get to do both, unfortunately. You don't get to do a little bit of a $1,000 tax deduction without receipts and then add on your other things. It is kind of an either-or situation, but I think it will simplify things for a lot of people that don't tend to have a lot of tax deductions and hopefully result in a bit of extra tax in their pocket while they're still working. The Working Australian Tax Offset. So there's always a bit of confusion around offset versus deduction. We love an offset. An offset often just means tax literally just back in your pocket, not a deduction, not slightly reduced tax levels, but money back in your pocket. So as long as you've had some income that's come through from working, so it could be employment, could be a sole trader, something like that, and it's likely to end up being taxable, you will end up with $250 extra in your pocket when you go to do your tax return, because it's purely reducing that tax liability, which we love to see. And the Medicare levy thresholds, look, Medicare levies are a tax that we don't talk about in terms of tax rates. most people, especially if they're still working, have incomes above a threshold where they're just paying a flat 2% on their entire salary for the rest of the year. So if we talk about a 30% tax bracket, effectively it's a 32% tax bracket because we need to add those Medicare levies on top. Now, if you have a very low income, you're either not required to pay that, or it's kind of a phase-in process where you might pay a little bit and those thresholds are just bumping up a little bit. So they're the quick and easy sort of ones. So we're not going to expand on those the most. We're then going to work into the changes to private health insurance rebates for retirees and older Australians, and negative gearing, CGT concessions, discretionary trust. So some of the big hitters in terms of the local budget. We've actually got additional slides that we're going to expand on a little bit more. So we'll go into detail about those ones. Just wanted to cover off a couple of things that we haven't expanded on too much, but just highlight the fact that there is about $3.7 billion additional coming to the residential care sector. That they're trying to increase beds. Basically, they're always trying to increase beds. It doesn't actually directly go to funding beds. What it does is the funding is mostly trying to incentivize providers of residential care to create beds. But it is making low means residents, so residents that don't have a lot of money and entering care, more attractive to have as residents by basically subsidising a little bit more money towards their care. So there were some significant changes in this sector on the 1st of November 2025, for anyone that wasn't aware. And an unintended consequence of a lot of those changes happened to be that low means residents were much less attractive to have as residents in terms of profitability in different residential care homes. And so they're trying to basically correct that mistake, if we want to put it that way. So essentially that's where a bunch of that funding will be going. And then there's a couple of changes that we knew were coming to superannuation, and we'll cover that off as well. So first and foremost, because this is the one that everyone seems to be talking about all over the place, is the capital gains tax changes. So there's basically two big changes, sort of separate changes that are happening with capital gains tax. Number one is the tax that you might actually pay in the way that they apply their tax rates. And number two is how they actually calculate that assessable capital gain. So number one, minimum 30% tax rate is brand new, introducing it now. So this is really going to make some really significant changes in terms of these strategic decisions we make around some of these assets in terms of selling them and things like that, because they have specifically called out an exemption for people who are on an income support payment from Centrelink. So when I say income support payment, could be age pension, could be job seeker, could be disability support pension. This has raised more questions than it's answered. Remember, all of these are proposed changes. So they've put a fair bit of information out, but they haven't nutted out the finite details about what that might look like or how it might be applied. So effectively, they're proposing that regardless of how, whatever capital gain is calculated on these gains post 2027, we are going to apply a minimum tax rate of 30%. Even if you have no other income in that financial year, you don't get your tax-free threshold, nothing, just 30% of that gain is going to be taxable, potentially more, depending on your personal tax rates and things like that. So they're introducing potentially an exemption for people who are on an income support payment. For me, it's raised a few questions, things like, okay, but do I have to be on an income support payment for the entire year? Are the discounts applied pro rata? Am I able to, or does it sort of coincide with me being on that income support payment at the exact time of the sale of the asset and things like that? So if you've been thinking these questions yourself, excellent. That's very, very smart questions, because they're the questions that I'm thinking as well. But we're still waiting for a bit of detail around that. But hopefully for most people that will result in a little bit of a benefit for older Australians when they are selling some of these assets. So the second component of this is how they're actually calculating that gain. So at the moment, just at a very, very simple high level, if you buy an asset for $100,000 and you hold it for more than a year, you sell it for $200,000, we've made $100,000. So then under the current rules, this ATO steps in and goes, all right, well, we're only going to we're only going to recognize half of that. We're going to ignore half. We're going to recognize half of that. And then, just apply normal tax rates on top of your employment income or whatever other assessable income there is in that year. And so the indexation approach, which actually was in pre-1999, they're looking at reintroducing something similar, where we're not just randomly halving the growth, we are what we call indexing the cost base, but we have a specific example around that to sort of nut it out in a little bit more detail. And whether or not you'll be better or worse off under these calculations, first of all, is really going to depend on how much growth is in the asset itself over time. And secondly, when you sold it, when you bought it, all those sorts of things. So there's a few things to be aware of. They have, though, applied some, not necessarily exemptions, but for what they classify as new builds, you may have the opportunity to continue to apply, to actually choose whether or not you go with one method versus another method. So you can kind of play around with both at the time and see which one results in a lower tax bill, essentially. And this, I guess, is where a lot of the ideas behind the changes have come from, is just to incentivize property growth, just literally physically increase the number of dwellings that are available to people. And they're hoping that that will encourage people to go for more of a new build if it's likely to have greater tax concessions. So a few things haven't changed. Your home, as long as you're on less than 2 hectares of land, your home will continue to be exempt. There's no suggestion of changes to small business concessions or anything like that. But there is going to be a fairly significant change come through if all of this goes through as proposed. So kind of wanted to touch off, okay, so who is actually better or worse off, etc. So this is somewhat of an interesting one. So the investors that may benefit are essentially the people who have very low growth in their assets. So take that as good or bad. Like if you have incredibly low growth in that asset, you win, but you lose. You don't have a lot of growth, but you know what? No, you're probably going to pay less tax under this kind of strategy. Look, a lot of the low growth assets, they're low growth because they have higher income. So it's not necessarily a bad thing, but keep in mind where investment returns are relatively low, either keeping pace or less than inflation, then you may actually be better off under this calculation. And we have a case study for that to kind of demonstrate a little bit. Investors that may pay more tax, people whose assets grow above inflation effectively, may pay more tax under the new scheme compared to how the tax is currently calculated. I guess a little bit of an unintended consequence is a lot of younger people have been putting investments into things like, ETFs and managed funds and other sorts of things, just trying to basically build some wealth behind them to hopefully enter the property market at some point. So potentially, if they've done that effectively and done a really good job growing those assets, then they may find that under the new scheme, the tax bill's a little bit higher. The 30% minimum also sort of eliminates the opportunity to just wait until you have a year where your income is low. So at the moment we would go, okay, well, I'm going to retire at 65. I'm going to sell all that investment property and I'm going to realize that asset. I'm going to use some tax-friendly super contributions and I'm going to use my tax-free threshold. I'm going to minimize the tax impact of that. And then a year later when I'm 67, then, age pension, etc. So we're really going to rethink the sale of a lot of these assets, particularly if they're purchased post July 2027, or there's a lot of growth that is applicable to that post July 2027 kind of base. So that long-term investors whose investments just materially outperform over time, ultimately under these new rules, will end up paying a little bit more tax. So the actual assets at an asset level, what's affected? So as we mentioned, the family home continues to be exempt, no change to like small business capital gain tax, etc. Affordable housing discounts, things like that. Investors eligible for new build housing may continue to access the 50% discount. As I said, you kind of get to choose. You go, okay, do I go the old method? Do I go the new method? Who knows? Whichever one works out better for me, I get to choose. So what is a new build? It's effectively something that results in more dwellings. So you either build something on vacant land, or if you buy a really old rubbish kind of house, you can't knock down, just build a new house with a few extra bedrooms and qualify. You would need to build more than one dwelling when you're knocking down an existing dwelling. So that's kind of what the new build energy that we're bringing to this equation is. We want to figure out how to expand the number of dwellings that are available and expand the housing that's kind of available is what we're really going with that. People that won't be impacted, as I mentioned, recipients of means tested income support payments. So age pension, job seeker, disability support payment, carer payment, things like that. They're exempt from the 30% minimum tax rate. Doesn't mean no tax, just means that any growth would be applied to your personal tax rates if there is income, available tax-free threshold, things like that. Overall, you may pay less tax. So this is what makes it interesting in terms of maybe timing the sale of these assets. Do I wait until I officially qualify? But there's still a few questions up in the air about, okay, what point in the financial year have you qualified, etc. So yeah, it'll be interesting to see how that kind of comes out in the wash. Once again, as a reminder, these are all proposed changes. So we're still waiting to see whether some of the policies will be softened or adjusted, and we're still waiting for some of the detail to come through to see what that might look like so that people can sort of plan ahead a little bit. So quick case study, because everyone loves a bit of tax equations. This is Michelle, and Michelle bought an investment for $500,000. And after 10 years, she has grown that to over $1 million because she chose, a high growth investment, did very, very well for herself. So the nominal capital gains, the difference between what she put in and what she initially took out is about $530,000. So under the existing scheme, we take that, just over 500,000 and we halve it. And that half then gets put on top of her employment income. So she's currently still working or has other income and has an income of about $100,000 a year. So that amount goes on top of her employment income. Then they apply her personal tax rates and she has to pay $115,000 of tax extra in that year because she sold that asset. Now, if the whole 10-year period she was holding this asset was post 2027, then we just wanted to look at what that might mean. So with this higher level of growth, exactly the same amount of growth, sold it for the same value, same what we call nominal gain, but how we calculate the amount of growth is different. So instead of going, okay, this is what it cost her and this is what she sold it for, we're going, okay, well, she put $500,000 in 10 years ago. What would that $500,000 be worth today if it just increased with inflation? So basically what we call it's retained its value over time. And so in today's dollars, that is $640,000. So the amount of gain we're assessing is actually the difference between the sale price of $1,030,000 and this new cost base of $640,000, which is significantly higher than what we had as the assessable capital gain originally. So effectively, we have capital gain tax payable about $173,000. So this adds around about $58,000 extra to Michelle's bill if we compare one scheme versus another in terms of how it's calculated. But we wanted to look at a situation where we have John. John chose his asset, maybe either has had less success with his investments than Michelle, or as I said, possibly just a higher rate of income ongoing moving forward. But John has, they both experienced inflation of about 2.5% a year, but John has also grown the asset 2.5% per year. So essentially the inflation has matched the growth in the portfolio itself. I'm going to assume for John's sake that he's just received a higher level of income throughout holding that asset. So what we have is the same amount of nominal growth, a little bit of capital gain, because it's, in dollar terms, he sells it for more, but it's just kept pace with inflation. So the money's worth the same amount, essentially. So the taxable capital gain under the old scheme is $140,000 divided by 2. So it adds $70,000 onto John's $100,000 income, and then he ends up paying about $25,000 of tax. Under the new method, though, he actually hasn't made any money. It's kept pace with inflation. It's done kind of its job where it hasn't gone backwards, but it also hasn't grown. So it hasn't technically in real terms made any money and therefore doesn't pay any tax. So in this particular situation, I feel like it's not necessarily unfair to say to people, hey, you haven't made any money, so we're not actually going to pay, and we're not going to charge you any tax on that. So it seems a little bit more reasonable, the outcome with this one. But ultimately, we just wanted to demonstrate that there are some people that may actually be better off, and it's all going to come probably down to how much growth is actually inside that asset. So that's, I think that kind of highlights how significant that change can be. And it's not very much black and white, good versus bad, but for a lot of people who are used to assets that are growing quite significantly above inflation over time, the calculations will be a little bit harsher. And I will note here that you should appreciate a good accountant, because their lives are about to get a hell of a lot more complicated once these changes come in. But, you know, complicated, let's say interesting. The life of an accountant when it comes to calculating capital gain tax changes, their lives are about to get a little bit more interesting. Okay. So that's capital gains in hopefully a simple enough nutshell, but feel free to bombard us with questions if you have, if you know it's raised anything that I haven't had a chance to answer yet. And we'll have a look at that a little bit later on. The second part of this that everyone's talking about is the negative gearing changes. So if you're not aware, up until now, if you own an investment property and the cost of owning that investment property outstripped the income. So by the time you borrowed and you paid interest on that borrowing, and there was council rates and maintenance and other things on the property, and the amount that you're actually forking out of pocket to maintain this property was greater than the income of rent that we were making from the property. In that particular scenario, you could use those losses to offset your employment income or your income off your other investment assets, new share portfolio, dividends, whatever it was. And they've gone, so the proposal is 1st of July 2027, they're just going to be like, for new, you know, you're going to buy a new property post 12th of May. Yeah, no, you're not going to get to do that anymore, not for you. So any losses that are incurred, you kind of have two choices. Number one, they can offset other residential property positive income. So if you have more than one property and one's positive and one's negative, maybe you're in kind of a neutral position. Or secondly, you can accumulate that loss. So you can't offset it against that year's employment or other income, but you can save it up. So if that property, you pay down the debt, for example, it gets to a point where it's now producing a positive level of income, then you can use the losses in past years to now offset this new kind of positive income. It also is proposed that you can then, if you accumulate enough over time, you can actually use that to help offset the capital gain if you sell the property in the future and you never actually had positive income to offset it. So these are the negative gearing changes. It just means that we no longer have the tax benefits of reducing a high kind of personal taxable income by using the losses year on year from these types of properties. So just to be clear, this excludes super funds. If you have an investment property inside a self-managed super fund, this is not going to impact you. It's also supposed to be grandfathered, so any existing dwellings that you own before the 12th of May. So what they didn't want, I guess, was people running out and buying a property before the 1st of July next year, hoping that they would be grandfathered. That's kind of why a lot of the time when these budget announcements come through, the cutoffs exist as the announcement comes through, because we don't want to kind of, I guess they're hoping not to mess with the property market in that way. But essentially, your grandfather, if you have an existing fund, existing property already, then it really shouldn't impact you because you should be grandfathered on those arrangements. This is really just for kind of future things. And this is another scenario in which you don't, you get new builds actually are able to access negative gearing changes. So trying once again to, increase more dwellings that are actually around the place by incentivizing people to look at building rather than buying an existing property. Okay, negative gearing. There was also a proposal. I'm not sure how many people this impacts in terms of our audience, so I'm going to just touch on this at a really high level. So the 30% minimum tax on discretionary trusts. I just want to touch on this because it actually tends to affect more people than you think that it would. And there's three main things that we need to think about. Number one is some families have assets inside a family trust, and it's not necessarily for incredibly wealthy people that have tons of money. We're talking farms. can sit inside family trusts. We're talking, you know, just small company assets, things like this. So this does potentially have the impact on small businesses, on potentially our agricultural community. So it has a potentially far more reaching consequences, even if it looks like it doesn't necessarily impact you straight away, at an individual level. Small businesses often have a structure where their accountant sorted it out for them, and there's a company structure. It feeds into, distributes to a family trust, and everything's kind of tied in together. So there's a lot of complexities here for people that have these structures in place. So what they've done is they've proposed, all right, we're going to give you 3 years to sort yourselves out. So if you need to look at, with this new change, with this minimum 30% tax on discretionary trusts, which will end up aligning basically with that minimum tax on companies, do you want to restructure? Do you need to move things around to kind of make everything, you know, suit you a little bit better? You know, if you want to restructure it, we're going to give you time. So when we say we're going to give you time, they have suggested that there is going to be some not concessions, but they're going to allow you to move assets around without triggering capital gains if it's, say, from a trust structure elsewhere, whatever may be appropriate for your particular situation. But what they haven't suggested is any kind of concessional or discretionary discounts to things like stamp duty. So if you're shifting a property from ownership of one structure to another, there hasn't been any suggestion at this stage that stamp duty won't apply, even if you're not triggering, you know, a tax liability, that kind of thing. So keep that in mind. The third category that they're not really talking about a lot here is testamentary trusts. If you have a will, and inside that will, it allows for a testamentary trust to be created, for assets to sit inside your estate and be distributed, usually with discretion, to different beneficiaries through that. It's a very, very common sort of structure that people see within their wills. It will affect discretionary trust, so non-fixed trusts. So if within the trust itself, you can decide how much goes to who, that's discretionary. If you have a trust that says everyone gets exactly 20%, that's a fixed trust. So it's not coming under the umbrella of these changes. But if you believe that there's the option of a testamentary trust inside your will, inside your estate, I would strongly encourage you to just review your will, have a look at whether it remains appropriate, and maybe potentially make some changes moving forward if that seems appropriate for you. So it's just something that's ended up being caught kind of within everything else that a lot of people aren't aware of. So that's why we just wanted to kind of make it clear that there are some changes that could affect more people than you think that they would. So yeah, once again though, it will be interesting to see if there's how this might impact sort of farming communities and things like that if changes aren't made. Now the next one, this one, I have to say, I believe that they very much buried the lead here, because I think that the changes here are much more likely to impact more older Australians than a lot of the other changes that they've proposed. And because we've spent so much time going, oh, capital gains tax, negative gearing, things like that, the lead was somewhat buried. Now, some of you may already be aware, some of you may not, that currently, if you're over 65, for the general population, you have a rebate on your private healthcare of 24%. If you are 65 plus, you have a rebate of 28, and if you are 70 plus, I think you have a rebate of, I think, 32. So the government has just proposing that we just remove those concessions for older Australians. So no, you're going to pay the same, you're going to get the same rebate as everybody else. So what that ultimately results in though is potentially an increase in health insurance, private health insurance premiums of up to 8% for the 70 plus category. And this is obviously going to be on top of that kind of standard 4% or so that we would normally see every year just from private health insurance. Now, I know a lot of people that I speak to are just like, no, we just want to make sure we can continue to keep our private health insurance because it goes up all the time. It's a really big chunk of retirement wealth a lot of the time. I hate to be the bearer of bad news, but it's likely later in retirement that, you know, it's just going to go up. So under the proposals that we've put through, We've got a specific case study here. So if someone's paying about $7,580 a year to have their cover, they are going to increase their out-of-pocket expenses for private health by about $600 a year, just over $600 a year, about an extra $50 a month. And that doesn't include the normal annual increases. So this, if this policy is put in place, that would literally we're expecting that instantaneously, suddenly your health insurance premiums will just go up by 4%, 8%, whatever kind of category that you fit into. So this one is, I think, a fairly significant change that has not probably been highlighted enough to retirees. And as I said, don't like to be the bearer of bad news, but I just want everyone to understand the implications of some of these changes. And potentially health insurance is already quite expensive and unfortunately may be about to get a little bit more expensive. So keep that in mind. But once again, proposed. We're hoping with some of these, these will be a little bit softened, or we'll wait and see what gets through, what doesn't. At this stage, none of this is set in stone. So pension supplement changes. We are lucky enough to have the age pension guru, Stephen, here today. So I'm just going to double check and throw this to Stephen. From what I understand, if you're on holidays for more than about 6 weeks, they're doing funky things with your payment, and now they're giving you a bit more time to holiday or something like that. If you want to maybe kind of clarify that a bit more for me.
Yeah, absolutely. So what the rule is at the moment is that if you travel overseas for less than 6 weeks, then your age pension payments remain as is and no impact. However, once you travel for more than 6 weeks, there is some reductions. Part of your age pension payment is 2 supplements, a pension supplement and an energy supplement. And those supplements do get paused at that 6-week mark. So you'll have a small deduction to your age pension payment from there. And so what this change effectively is increasing that period up from 6 weeks to 12 weeks now. So now you can travel abroad for up to 12 weeks at a time with no change to your pension payment. And it's only once you get to more than 12 weeks when you'll start to lose those 2 supplements.
Mm. And look, we see this all the time because Europe is a really, really long way away. So a lot of the time, if people go over there, they're not going there, so they might go there for, say, 2 months or more. And so those last couple of weeks just give that little bit of a whack where you get that bit of a reduction in the end and you have to wait till you're back in the country to see that boost. So I think that seems more reasonable. So if you can afford a European holiday, you can be away for a little bit longer, essentially, without having to worry about it.
Absolutely. The one thing I would just clarify, if anyone is looking at doing this, is there are other rules regarding long-term stays overseas. This isn't the only one. This is the only thing that's changing, which is why we're highlighting it. But if you are looking at a long-term trip overseas of more than 12 weeks, there are other things that may impact us. So definitely do some research into that before you go, just so you are aware. This is the one that's changing, but there are others.
Yep, for sure. Okay, so support at home changes. So I'm just going to quickly cover this off. This one is particularly close to my own heart. I do a lot of aged care consultations with people who have either loved ones or are themselves entering care, but also have been trying to navigate the support at home kind of packages and how all those arrangements work, the consequences from a financial perspective. So as I mentioned earlier, there were a lot of changes that came through on the 1st of November 2025. And one of those was that they're now categorizing these different kinds of support you can get in home. And depending on how you apply that funding, you have to participate in the cost of your care. And so for some people, you say, well, if you can afford to participate in the cost of your care, absolutely. But even someone who is on a full pension, for example, has been expected to participate contribute at least 5% of the total cost of accessing some independent support and other kinds of services. And unfortunately, things like personal care and continence care and showering, those kind of things have come under that category. So even as a full pensioner, if you had not a dollar to your name, you would still be expected to contribute 5% of that cost. So I don't know if anybody is familiar with support at home packages, but because obviously there's layers of administration, this, that, and the other, the hourly cost for these kind of things can run well in excess of $100 an hour. So for example, if you wanted to have 4 showers a week, there is $20, and that's $40 out of your fortnightly age pension. That might not sound like a lot to a lot of people, but it makes a difference between eating a healthy meal and eating 2-minute noodles for a lot of older Australians. And so anyway, this change has already happened. Excuse me. They've stepped in and they've said, nah, okay, fair enough. The advocacy in that space, people working in that space, people, advocating for themselves who are suffering through this really was very successful, and just kept campaigning to the government and said, you can't expect people to, decide between food or hygiene. And so that's now coming under the umbrella of no contribution. So you don't, anyone at any level doesn't need to actually contribute towards the cost of their own support for her personal hygiene. That's coming under that new personal care services, which we love. That is definitely a massive step in the right direction. That's actually not coming in until the 1st of October, but it is changed and it will happen. So this one's not proposed. They've already turned around and done a backflip. They just haven't done it immediately. So that's going to take effect as of October. And support at home changes, everyone, the waiting list, 12 months. 12 months. So you have somebody who's desperately looking for help in the home. They get approved. They say, okay, yep, you need, you qualify for support at home package 5. We'll see in about 12 months when your package gets allocated. And so they're trying to work on accelerating those packages. So hopefully we're going to get additional packages. A lot of this is just bringing the packages forward, to be honest, rather than creating new ones. They were supposed to be released later. But either way, hoping to support more people in the home sooner rather than later. And just quickly to cover off super changes, none of these are proposed. These are not budget measures. Just a reminder, from the 1st of July, we have your normal changes to caps, so slight increases in your before and after tax contribution limits. And so these will apply as of the 1st of July. Division 9296 tax, very controversial, been waiting a while. It is coming in as of the 1st of July. So this is tax on additional tax on earnings for balances above $3 million in super if you have a balance that high, and another extra bit if you have more than 10 million. Payday super, this is actually excellent for anyone who is still working. The number of people that have missed out on superannuation contributions because their employers weren't paying them, and you don't notice because previously you only had to make super contribution payments a minimum of once every 3 months. And so it was so easy to lose track when you're getting a statement once a year from your super fund of whether those payments are being made or not. So payday super, you're going to get payments once every fortnight, or whatever your pay cycle is. So basically the payment needs to be made within 7 days of your actual physical salary being paid to you. So that should help keep everyone on top, and compounding over time will add a few extra $1,000 when you get to retirement, but it's also going to keep people a little bit more accountable in terms of making those super payments. And transfer balance cap, this is just moving funds to the pension phase of super. The cap's just increasing in line with all of the other thresholds. So that's just, at a higher level, a few changes coming through. Maximizing entitlements. Now, going to get back to the guru on this one, because this is a reminder, very, very valuable reminder of a few things that if you're on a part pension, it might actually help. Stephen, with the age pension entitlements.
Thank you, Nicole. So a couple of, just key simple things here that hopefully some people can walk away with some value from in terms of key ways to maximize your age pension entitlements. These are based on sort of the most common issues that we come into when me and my team help customers with applying for the age pension. And the biggest one far and away is the misvaluation of your assets, in particular personal assets, so things like clothing, jewelry, furniture, appliances. Most people don't really think about those values, and so when you're presented with this question by Centrelink, your default position is to think, well, they're insured for 100,000, so I suppose 100,000 is their value. But that's replacement costs if you had to buy those things new. Centrelink are actually assessing the private sale value. If you had a garage sale, put it all in the front yard, how much would you get? And that figure is almost never going to be $100,000. So you just need to make sure that you are approaching this eyes wide open, understanding what Centrelink are asking, so that you can answer the questions correctly and accurately, and not penalize yourself, because they won't come back and say to you, oh, 100,000 looks a bit high, are you sure? They will just take it as, okay, 100,000, and you lose $3 in age pension for every $1,000 of assets that you have above the minimum threshold. So that can be quite a substantial impact on your age pension payment just for that one simple to make honest mistake. that you won't even necessarily realize you're making.
Yeah, I think that's so true. I had a client years ago. They'd been on age pension for about 5 years. They were receiving a part pension because they were asset tested, and they'd originally put down about $80,000 for their contents. And so we got them to review it, obviously, immediately. But over that 5-year period, we added up that they'd missed out on about $50,000 of age pension entitlement. So it can actually accumulate to quite a significant impact if you're over disclosing those details.
Yep, absolutely. The other big one that's really good, particularly if you are of the younger demographic and planning ahead, is the final point there around gifting. The gifting rules apply for a period of 5 financial years from the financial year that the gift is given. After that, the slate is wiped clean, effectively as if it never happened. And so if you are younger, the age of 67 to apply for the pension. If you are 60, 62, even if you're 65, if you're thinking about gifting, don't necessarily wait until you're on the pension to do it. You can do it sooner if that's what works best for you and your financial situation, because that means you can effectively serve some of that 5-year waiting period before you even are eligible for the pension. So it impacts your age pension for a shorter period of time. Instead of being a full 5 years of pension that is reduced, it might only be 2 years because you gave that gift a few years early.
Yep. All right. So yeah, there's a few ways that if you're on that part pension space that potentially could benefit you. So it's definitely worth looking into either ahead of time, or if you are already on a pension, some of these are still relevant. They will not automatically depreciate your assets if you're already on a part pension. They won't do it. So your $50,000 car that you bought 5 years ago is still worth $50,000 as far as they're concerned. So you want to review the value of those assets. It's not just about valuing them correctly when you start the age pension. And here's where we get to sort of our favorite part of today, which is really just trying to answer some of the questions, some of the burning kind of ideas that have come up and popped into your brain while we were talking through everything that we've worked through today. So the budget changes and the super and all those sorts of things. And so we're going to have a look at whether or not there's some questions that we can help to answer.
Excellent. Thank you so much, Nicole, for going through that presentation. Please take a moment to rest your voice, grab a glass of water, and as we're collating the questions. Thank you so much. There's been lots come through so far, but it's not too late. Please post any more you might have in there. We'll look to answer as many as we can today. Just in terms of the answers, I'll just remind everyone, we are going to be sending out a copy to this meeting, to this webinar later today. So don't have to panically try and scribble every answer we give down and write it down straight away. That's just not necessary. Take it in, absorb it as best you can live, but you can always come back and rewatch it later if you need to, get a specific number and jot it down or anything like that. Like I said, we plan to answer as many questions as we can. So Nicole, once you've had a bit of a breather and had a glass of water, let me know and we'll dive in.
Yeah, I just wanted to check as well. So if there's anyone watching who's getting a recording, if they think that they've got friends or family that could be interested in the content that might be relevant to them, are they able to just forward that link on? Do you know?
Yes, no, absolutely. So we can forward the link on so that anybody can watch this session. So that's perfectly fine.
All right. Okay, great. Yeah, I'm good to go.
Alrighty then, fantastic. So question 1, what do the proposed capital gains tax changes mean for an investment property held in an SMSF, a self-managed super fund?
Okay, yeah, so absolutely no change at all. So the way that tax rates apply within a self-managed super fund is completely unaffected by these changes. So it's only really if it's held by an individual or a partnership, it's outside of super. So I don't want you to be concerned that there's nothing in the proposals whatsoever should have any kind of negative or change in calculation for those assets held inside the self-managed super fund.
Beautiful, thank you. Next one, how do the capital gains tax changes affect me if I'm only on a part age pension? Am I still exempt from the changes?
Yeah, from what we've seen, we've looked through the work, we've looked through the budget papers. As I said, there's a few questions up in the air, like when you sell the asset, do you need to be on it at the time or just during the financial years, the bits and pieces. If you're in a part pension, it just says income support payment. It does not suggest you need to be on a full income support payment. It just you need to be in receipt of some kind of income support payment from Centrelink. So our assumption, our very educated assumption based on working through those budget documents would be that you would qualify for an exemption from that 30% minimum if that's what you're concerned about. It does appear. But one thing to think about is if you're a member of a couple, for example, and the asset is in joint names, then those discounts or those exemptions, they're applied at a personal level. So if you sell the asset, it's jointly owned, and the tax consequences are split exactly 50-50, then in order to get that exemption for both of you, you both need to be on an income support payment. So if one member of a couple is on an age pension, for example, then they might get the exemption. But if the other partner is below age pension age, not receiving any income support payments, they won't receive the exemption. So it really just depends on individually where you're at, if it's joint asset as well.
Beautiful. This next one I might cover off. So somebody's asked that if they're no longer working, do they still need a Medicare card? Short answer, yes, absolutely. Medicare card provides access to a bunch of things, like, most importantly, cheaper medicines and subsidized healthcare. So that still applies and is still valid and relevant to you whether you are working or not. It can also be help tied to your citizenship and residency status as well. So it's absolutely normal, and you absolutely should look to continue to keep your Medicare card throughout retirement, regardless of whether you're still working or not. So one of the next questions that came through was regarding changes to the private health insurance rebates. And Nicole, I know you did do a slide covering this, so this question did come through before that slide. Hopefully it has been answered. The question was went along the lines of the pensioner concession. So one thing I'll just clarify is, with the age pension, you do receive what's called a pensioner concession card. And so that card and its associated benefits are not impacted in any way by anything that's been discussed today or anything in the budget proposal. That is separate, so those concessions will not change. The difference, what is changing, as Nicole noted on that slide, and Nicole, you can add anything extra if you like, is just in the terms of the rebate and the net cost of private health insurance.
No, you're absolutely right. There's no suggestion whatsoever that you will continue to access a higher level of rebate if you have a pension concession card. It's basically, previously you didn't actually have to qualify for a pension concession card or any kind of concession card in order to receive that rebate. It was just applied purely based on age. And so the proposal is that those additional rebates are just being removed. So at this stage, we're not expecting any, that is how we're expecting it to apply based on the proposal documents. But once again, it's a little bit of a wait and see. If they choose to soften anything, I would be surprised if they don't soften that a little bit in terms of how they proceed, but it's very much a wait and see.
Beautiful, thank you. Okay, next one. I stand to inherit my mum's house in the next few years. I'm concerned about death duties. Is there any inheritance tax or similar that I should be aware of?
So in general, if you're inheriting somebody's principal place of residence and it has been their principal place of residence the whole time that they were living there, then you should inherit it with no capital gain implications. So there should be no tax to pay on that. But there's a lot of disclaimers there depending on, maybe it was owned by a trust structure or there might be other different things. But if it's just as purely as simple as mum and dad bought their house and then they held it and then they passed away and they gave it to me, then there should be no tax payable. Now, you inherit it with no tax payable, but if you choose to keep the house and you're not living in it yourself and you sell the house later on, potentially you might pay some tax, but only on the growth from the date that they passed away until the date that you sold it. If the property is sold within the first 2 years of them passing, then any growth is ignored, so there shouldn't be any tax implications there. But yeah, if you choose to hold it as an investment property, potentially over time you might accumulate a capital gain, but it is only really from the date that they passed, not from the date that it was originally purchased by your parents. Now, as I said, a couple of different complexities there. If they had rented it out for a while, things like that, there might be some tax implications, but principal place of residence exemptions generally apply in a fairly straightforward way for most families and most of that standard home ownership.
Excellent, thank you. Oh, this is a good one that's come through. So, following the proposed budget tax changes, why are people saying investing in super is more powerful than ever now?
Okay, so a lot of people have, first of all, been choosing to invest outside of super because there was the 50% concessional tax discount, things like that. So inside super, while you're working, you're accumulating your wealth, etc., tax is levied at 15%. And so tax on earnings, tax on kind of tax-friendly super contributions, it's levied at sort of 15%. And so the attraction of super is really just getting to retirement and being able to transition that into what we call the pension phase of super, which is 100% tax-free. Outside of your kind of family home, it's essentially the most tax-effective investment in Australia, arguably, to have funds in super. Now, a lot of people have kept assets outside of super just because they want the flexibility of being able to access them. So that is one of the restrictions. Yeah, we get all these tax benefits with super, but it's pretty locked away. You know, you can't access it easily. It really is planning for the future. So a lot of people are purchasing assets and other things outside of super. And with the current tax concessions, a 50% discount on that gain. So for example, you know, I grow it with that original example I had. You buy for 100,000, you sell it for 200. I made $100,000. You know what? We're going to halve it. We're going to assume you only made half of that, and then we're going to apply tax rates. It's a fairly concessional way of applying that tax. If you were earning that same money from your salary, you'd be taxed at a much higher rate. So, well, potentially. Now that those tax rates won't apply, and especially with those high growth assets, potentially might end up paying a lot more tax down the track. People are potentially willing to commit more money to super. Even though they know it's locked away and it's a little bit more restrictive earlier in life, people are willing to commit more assets inside that space because they just want the tax concessions. Especially a lot of people have things in like family trusts. You used to be able to distribute income from a discretionary trust and be like, all right, Jojo didn't earn much this year. We're going to give him like 45 grand. We'll take care of his lower marginal tax rates. And then, well, he's got a higher income. We're only just going to give David 5 grand. So you had all this discretion about how to distribute things in ways that minimize tax. And then from this minimum 30% for trusts and things, it might actually shift the way that people choose to position their assets. So I know that probably sounds a little bit sort of complicated, but essentially it's just making super more attractive because there's less tax concessions available in other spaces. I probably could have just said that to start with, but
clear as mud.
That's where we are. Yeah.
All right, then. So we've got a few minutes left. We still have a few more questions to get through those. So let's power on. So the next one, I'll cover off this one, Nicole. So somebody's asked, how often does Centrelink assess your property value for the purpose of asset test assessment? So great question. Technically, Centrelink advised that the time frame is 12 months. If you go online and have a look for it, that's what it says. But from our experience, and we've been doing this, I've been working with this company in charge of the pension team for about 5 years now. We're seeing it's actually more like every 2 years, every 24 months is when it happens. It's based on the anniversary of your pension approval. So it's not like it's just every June, every year, for example, they go and revalue every property. So it's based on, your anniversary of when your pension gets approved. So within 2 years is what I would say is the best answer we can give. Our experience is it's generally been closer to the 2-year mark, but officially they do advise it's every 12 months. And just to bit of a follow-on question to that one, although that might be how often Centrelink does a revaluation, it doesn't mean you can't revalue yourself during that time. There's absolutely changes that can happen that could, devalue your property. If there's happen to be a new tip open up next door, for example, you can request Centrelink a reassessment of it. It's up to 2 years is how long Centrelink will take to do it themselves, but you can do it yourself during that period if you wish. Okay, next one, this one back to you, Nicole. Can I offset my CGT with a concessional superannuation payment?
Look, when you sell an asset and you realize a capital gain, and we calculate depending on either system that we're under, okay, you have this assessable capital gain of, say, $50,000. We're going to take that $50,000 and we're going to put it on top of your other taxable income. And so whether or not you can use those kind of concessional super contributions will depend on 2 things. Number one, what is your total taxable income, and it is actually a benefit. So we make concessional contributions to super, we're taxed at 15%. So if you're in a marginal tax rate from next year onwards of less than 45,000, you're paying 15% or less, plus a bit of a Medicare levy possibly. But the advantages there aren't particularly significant. Secondly, are you eligible to make concessional super contributions? So if you have a high taxable income because you've sold that asset, but you're over 67 and no longer working, you're not eligible to make those types of contributions. But outside of those kind of situations, yeah, if you're under 67, you have capacity in your thresholds to make concessional contributions to try and offset some of that tax impact, then there's no reason that you can't, because it's actually just a lot of the capital gain tax is about how we calculate the growth. At the end of the day, the taxable growth just goes on top of any other income you have in that year, and it applies in the same way that when you go to do your tax return, your accountant's like, okay, you made this much income, these are the deductions that you have. One of those deductions could possibly be a concessional super contribution. So yeah, you can do it. It would just depend on your eligibility at the time and what your actual taxable income is to make sure that it's actually worth it.
All right, fantastic. We've got time for one last question that we'll slot in before we do need to wrap things up. So, Nicole, this one is for you. What should I be thinking about when deciding whether to add to super or to pay down the mortgage before being assessed for age pension?
So there's, excuse me, there's two things that I want you to consider. At a higher level, you know, pre-age pension, no implications for that whatsoever. We might just be looking at, okay, what can I possibly earn on my super versus what is the interest rate on my mortgage? So at a higher level, it seems like that's really the main thing. But over the long term, what we find is that we expect super in general to outstrip interest, like mortgage rates on your interest rates on your mortgage over time. But that's sort of over the long term. So if you're 65 and you're planning to fully repay your mortgage at 67, then any investments in super, if there's a lot of growth in there, are very much subject to kind of market risk and things like that. So there's a consideration there that requires a much greater conversation around where your comfort is, when you're planning to repay it, how far you are from retirement, things like that. But the other part of the equation is if we're talking about cash flow, you've got a little bit of spare savings income coming through that you're not using, and you're trying to figure out, do I pay a bit extra off my mortgage regularly or do I pay it to my super? We first want to know, are you maximizing your concessional super contributions? So if you have an income of $100,000 and you have an extra $10,000 that you can put towards either your mortgage or to your super, if you salary sacrifice to super, you will pay 15% tax on that $10,000. And what happens is it reduces your personal taxable income by, which is in this 30% or 32% tax bracket with Medicare levy. So it's almost like this instantaneous guaranteed return on investment of 17% because of the tax benefits of doing that. So over and above that, you know, your limits to make sort of tax-friendly contributions, we might more be looking at, you know, interest rates versus earnings on super and things like that. And that's a much wider conversation. And not making any specific recommendations here, but if you have capacity to either salary sacrifice to super or make contributions to super, claim a tax deduction within your annual limit, the tax benefits there just deliver a really great return on investment, especially if your personal income is above about $45,000 a year. So in most cases, it just makes financial sense to prioritize that at least up until your limit if you haven't already. If you have already used all that up, then, you know, yeah, come have a consultation, speak to your accountant, something about, you know, work it through with someone as to which one is more appropriate with your circumstances, how far you're off from retirement, things like that. But the tax benefits of salary sacrificing to super just create like a really great opportunity to boost your super, which would hopefully create a greater balance at retirement that could knock a big chunk off your mortgage anyway, compared to what the balance would otherwise have been. So just something to think through. Yeah, it really comes down to, yeah, your concessional contributions and the tax benefits of doing that.
Fantastic. Rightio. Well, that is all we have time for today. Thank you again, Nicole, very much for such a lengthy and well-explained session. Really do appreciate it. I'm sure all the people watching at home do. Thanks for all the questions you guys have asked. Really have appreciated that. I'll just quickly move on to the final slide of the pack. Just has our contact details. If anyone does have any follow-up questions or need any further assistance, our details are on the screen here in front of you, so you can shoot us an email, give us a call, or you can book a consultation online via our website if you wish. Otherwise, do keep an eye out in your email inbox. As I said, we will be sending through a follow-up email with a link to this. You can go back and re-watch it and look at particular sections or go through that Q&A again if you wanted to jot anything down of importance or share it with friends and family. By all means, go for it. Otherwise, that's it from us here at Retirement Essentials. Thank you all. Hope you have a good afternoon, and goodbye.
Okay. Thanks, Stephen.